Well, good afternoon, everyone. Thank you for joining us this afternoon for our third annual Navigating Financial Markets Day here at North Dakota State University. I'm Scott Beaulier, Dean of the College of Business, coming to you from Richard H. Berry Hall, where we all wish we could be gathering today. We have a great new event space that we look forward to hosting our fourth annual conference in next spring. So mark it on your calendars. We'll be back at this again in April of 2022. And this day is a really special and fun day. We have three great panelists. We're going to talk about the state of financial markets for a little over an hour, and then do something a little bit different and focus also on careers in finance, and talk to our industry experts about what life is like in the industry, what they'd recommend for our students. So if you're interested, stick around for that. If you're a financial expert on the call, feel free to drop off after you hear their commentary today. So without any further delay, I want to first acknowledge our sponsors and partners on this wonderful event that we do, the CFA Society of Minnesota. We have Mark Salter joining us today. And Mark, if you want to just say a quick hello. Thank you for this continued partnership. Really glad to be doing it again virtually, but so be it. I think it'll be a great set of content today.
I agree, and thank you again for allowing us to be part of this event. I'm going to share my screen really quickly so that you can see who we need to thank today, who I need to thank. Lisa and Mark and Robert from members of our CFA chapter here in Minnesota, and we also cover North and South Dakota. So we have a wide footprint here. So I love this slide because it looks like we're taking credit for the whole thing when all of the hard work has been done by the dean and by Fariz and Callie behind the scenes, all of the good folks up at NDSU. So thank you so much for allowing us to be part of this event. And I'm looking forward to being in Fargo in person a year from now. So one more slide. We always thank our annual sponsors, the firms you see on the screen here. These are the firms that generously every year give of their time, talent, and treasure to make sure that we can participate in events like this, provide professional learning opportunities, networking opportunities for our members in the investment industry. So we can't do it without their support, and we take every chance we can to thank them for that. With that, I'm going to get out of the way because you're not here to hear me. You're here to hear the good folks who are about to walk you through the state of the financial markets right now. So with that, take it away, guys.
Thanks, Mark. So just a couple of notes about the rules of the road today. We're going to have each participant present for about 12 to 15 minutes uninterrupted. I will come back as each one goes for a quick and full introduction. And then after their presentations, I have a few questions that are canned and ready to go. But my knowledge of finance is about an inch deep these days as Dean of Business, who's running a college day in and day out. So we would love audience questions and participation. You can submit them in the Q&A down at the bottom of your screen. It is a wisdom of crowds type of format. So if you like someone else's question, click like on it, put a thumbs up or whatever is required, and we'll move that to the top of the queue. So please help us ask these great guests some good questions. We're going to start today with Lisa Erickson, Senior Vice President and Head of Traditional Investments at U.S. Bank. As head of the Traditional Investments Group, Lisa is responsible for directing all aspects of traditional investment research and fund manager selection for U.S. Bank Wealth Management. This includes due diligence, strategy research, idea generation, data management, and client research. The platform of approximately 300 strategies includes both active and passive options in all key investment styles. Lisa has more than 25 years of experience in the financial services industry. She may seem like a familiar face to you in that we see her on television quite often, and you can go and look at some of her most recent commentary on financial markets. She's a member of the CFA Society of Minnesota and the CFA Institute, and has a passion for serving her community, demonstrated by her participation in a number of charitable endeavors. Lisa, thank you for being here, and we'll turn it over to you.
Great. Thank you so much, Scott and Mark. It's really an honor to be here. So I'm looking forward really to the opportunity to connect with all of you there in the Fargo area and surrounding cities. So thank you again for the opportunity. If you give me just a second here, I'm going to go ahead and bring up my slideshow. And with that, I'll look forward to diving right in here to give you our current thoughts on the market. And again, looking forward to interacting a little bit later in the presentation with any questions that you have. So as you can see from the slide here, big picture, we are optimistic on the economy and the markets as we look here through the remainder of 2021. Essentially, I'd say we have a glass half full positioning, and it's not going to be surprising that glass half full is really on the back of the great progress we've made on the vaccination and the COVID front. And if you roll back, to just about a year ago, obviously it was a very different situation. We were actually just before 12 months ago looking at, one of the longest economic expansions that we had had. And the debate at that time really was around, how long can that economic recovery continue to take place? And then roll forward just a few weeks later, we all got obviously unexpected news, something that was very hard to predict, but we began into this journey into what is now currently the COVID pandemic. So if you roll forward to what's happened since then, it's not surprising that as we as an economy have been able to address what's going on with COVID, that has certainly sharpened our prospects for recovery. And so what I'd like to do just in the next few minutes is talk a little bit about why on the back of that vaccine and the COVID progress, as well as the data that we see both in the economic and the corporate earnings front, as well as policy support, again, why we have that glass half full outlook. And it isn't all roses. So if you focus on that very bottom bullet point here on this slide, there are some things that we're monitoring, and chief among those is really on the policy side as growth continues. Should interest rates rise particularly rapidly and or inflation, that could choke off some of this positive recovery that we're seeing. Okay, well, I said I would share a little bit more background and data on the reasons for these positive views. This first chart here shows really what's been going on in the vaccine front. And if you've been following, what U.S. Bank Wealth Management has been saying in the news about our outlook, we've maintained throughout this really that the key variable is really the progress on COVID. It is what, slowed down the economy. So again, as we are able to make progress on that, that really is one of the key linchpins going forward for what the outlook is. And what you see here on this chart is first in the bars, just the progress that we've made in terms of vaccine doses that are administered per day. And then the line is actually just the 7-day moving average. And not surprising what you see, if you go back to the beginning of the year, we've made substantial progress. In fact, more progress than I think many of us would have thought back in January, even though that was only just a few months ago. Again, if you look at the beginning of the year, what you see is at that time, we were somewhat just under 500,000 doses per day. And again, you can see that steady rise upward over time, so that when you move to today's trajectory, what you see is we're almost at the 3 million mark in terms of average daily doses. So again, a very positive outlook for activity to begin to pick up on the economic front. So what's the actual economic data? Well, that's a great question. And we've got a chart here really to encapsulate what we're seeing in terms of the economic outlook. So let me spend a minute just giving the context on how this particular chart works, and then I'll share about, what the data is actually showing on the chart. So this chart actually shows two dimensions of economic activity. On the horizontal axis, what you actually see is how over 1,000 global economic indicators plot just in terms of the current level that they're at. So anything on the right-hand side above 50 is essentially saying that economic indicator is indicating that the economy on that particular factor is in a growth mode. And if it's on contrast on the left-hand side below 50, it's saying we're in more of a contractionary mode, at least on that particular variable. The vertical axis, by contrast, is not just the level, but it's actually the change in the level from month to month. So if this particular month, let's say an economic indicator is at the level of 50, and then we measure it the subsequent month and it's at 55, that particular indicator will plot in the top half saying it's growing month over month, and vice versa. If it's actually contracting, it will go on the bottom. So obviously the best place to be on this chart is that upper right-hand corner where you have a good level of economic activity, as well as showing that month over month, that particular indicator is growing. And what you see from the plots that we have here, actually in terms of the lines, whether you're looking at the US economy or whether you're looking at major developed markets like Germany or France, or whether you're looking at emerging markets, what you actually see here is a very nice progression over the last 3 year ends ended April. And essentially what you see is that the economic data on an aggregate basis is showing that the economy is actually rotating up and to the right, as again, vaccinations having improved and we've been able to make progress on the COVID front, and that's being reflected in economic activity, not only here in the US and the globe. The other interesting thing that I'll point out about this chart is while we've got that nice trajectory across the globe, what you see is there are some differences in relative positioning. And so if you focus on that blue line, which is the United States, you actually see that for that a particular region, as well as the emerging markets, you actually see that the trajectory is furthest over to the right. And so that actually is underpinning some of our bias, particularly within the positive outlook for markets towards the US, as that economic reopening has picked up the pace to the greatest degree, as well as in emerging markets where they were first in and first out on the COVID pandemic. Okay, great. Well, you say, but you know, the bottom line is how does, especially for the stock market, some of this information reflect itself in terms of actual corporate earnings. And so here, if you focus on the top table on this chart, what you see is what's happened here in 2019, as well as last year and going forward. And if you focus on those middle sets of columns there where you're showing the year over year change in particular growth rates, you see that that economic activity that we saw that was so positive on the prior page is reflecting itself in forward earnings estimates. So if you just focus in that 21 over 20 year over year earnings estimate look, you see that again, as we continue to recover, analysts are optimistic on how that's affecting what we're seeing in terms of corporate earnings. And you see that nice 28.3% growth rate. And in fact, that's expected to continue on into 22 over 21 with another 15.5% improvement in the corporate earnings picture. Okay, well and good, you say. So things are looking positive in terms of growth, both on a big picture macro basis, as well as what's happening in corporate America. But of course, there's other variables to consider. And a key one is really just the policy front and the environment in which stocks and bonds can perform. And so what this particular chart shows you is actually what's going on with interest rates, because interest rates are certainly a key driver of what's going on in the economy. To the extent that interest rates are low and more accommodative, that can spur more economic activity as people have access to financing. So what you see here on the 4 colored lines is essentially what the interest rates are for the US Treasury bond at different maturities ranging from 2 years to 30 years. And there's just a couple of key points that I'm going to make on this particular chart. First, if you take a look at this 5-year view, what you'll see is that even though recently interest rates have picked up, if you look again at the bigger picture over the intermediate term, they are still within the same band that they've traded within the last 5 years. And if you look at the absolute level on the left-hand axis, overall interest rates are still at absolutely low levels. On this chart, ranging anywhere between about 0.5% and 3%. So again, a very favorable environment to help the economy continue to heal and recover. The other thing I will point out, however, on this chart is if you focus on the very right-hand side of this particular interest rate chart, again, as I just mentioned, we have seen just in the last couple of months, interest rates begin to pick up, and not have only they picked up, but you'll see the difference between the 30-year, which is in that burnt orange line, as well as the bottom 2-year line, which is more of a black or dark blue line. You can see that longer term interest rates have picked up relative to short term. And so there is some belief that the bond market is showing that, again, as growth picks up, that could push interest rates up. And overall, again, while interest rates are low, should interest rates continue to increase at a rapid pace, that could actually have then negative effects overall on the economy, simply because, again, the ability to access additional financing is then reduced. So that leads us, even though we have a glass half full outlook to, what are the risks? And at this time, before I turn it over to my co-presenters, really the key one that we would point out at this time is really, again, the risk of interest rates and or inflation increasing, because again, not only could that reduce the access to financing, but that in turn could actually have an adverse effect on our policymakers, particularly our Federal Reserve, because to the extent that they see growth picking up and they see potentially inflation picking up as growth picks up, they could at some point step into the market and preemptively raise the rates of interest, again, cutting off some of that growth potential. So that is actually one of the key risks that we're continuing to monitor as to whether policymakers will flinch. And with that, I look forward to the questions we have later, and I'd like to turn it back to Scott.
Thank you, Lisa. Really fascinating presentation, and we'll be back to you in just a few minutes. Our next panelist is Mark Simenstad, Chief Investment Strategist with Thrivent Financial. Mark serves as the Vice President and Chief Investment Strategist, and in this role, he oversees the investment management of all Thrivent Financial and Thrivent Mutual Fund assets. He also serves as a co-manager of the organization's 4 asset allocation funds and the Thrivent Diversified Income Plus Fund. He joined the organization in 1983 as a securities analyst. He held a variety of positions, including head of fixed income research and portfolio manager, before leaving the organization in 93. Simonstad was employed by Investment Advisors Incorporated as vice president and portfolio manager, and subsequently joined Voyager Asset Management as chief investment officer, fixed income, from 96 to 99. He rejoined Thrivent in 99, becoming head of fixed income funds in 2002, chief investment strategist in 2017. He is a chartered financial analyst and received a bachelor's degree in economics from St. Olaf College and MBA from the University of Minnesota in Minneapolis in 1983. Mark, thanks for joining us, and the show is yours.
Thanks, Scott. Wow, that's a mouthful. I'm going to share my screen here. There we go. Hopefully you can all see that. So I'm going to take, like Lisa, just a very brief review of the markets with an even briefer review of maybe getting a little more granular on how we build portfolios. Scott mentioned one of the things that I'm involved with fairly heavily at Thrivent is our asset allocation funds, which are multi-asset funds. So I thought I'd spend a little time on how we build those, and hopefully touching on some things that you as students have maybe been studying, to hopefully show that, yes, indeed, some of the things you study actually get put into practice in the real world. So hopefully we'll get a little taste of that. Let's see here. There we go. So similar to Lisa, we have I'm going to start with the big picture, and that is what's going on with the economy. And similar to Lisa, there's a ton of data points out there. This is our approach at trying to encapsulate what are, basically 1,000 data points in terms of the economy, and putting it into just a simplified schematic as to where we are. For us, this is akin to what I'd call a blood pressure monitor, whereas down means that stress is being relieved in the economy and a high number is problematic. As you can see, as we came, even as before the pandemic hit, the economy was having some issues. If you recall, there was a lot of trade friction. There was some indications that the economy was slowing, et cetera. And then the pandemic hit. And then we really got into what is the gray bar, which is a recession. It'll probably be one of the shortest recessions on record, however, because of its shortness and because of the dramatic support that came in from the government. But nonetheless, you can see it's just been a fairly swift decline from pretty elevated levels in terms of our indication, our numbers. I'd like to show this as well because we talk a little bit about what are careers out there for students. And in order to come up with this information, we have a team of data scientists as well as programmers and analysts that are very involved in this. So that's one thing I wanted to emphasize throughout my presentation here is the number of different jobs there are out there in the investment management business that are changing to a certain degree. But anyway, getting a little more granular on the 4 points there, what's really driven the economy, we think, to this vastly improved performance that we've seen just recently. And obviously it's been government support, but we've seen pretty resilient demand because of that government support. Retail sales numbers came out today and they were surprisingly robust. The consumer never really went away. Secondly, we've had very strong resurgence in employment. Claims came out today were surprisingly strong, or surprisingly resilient, I should say. And also we've seen manufacturing has really hung in there. To the extent now, though, that there's some concerns about supply chain management and some pressures in supply chains. Finally, as we all know, housing has just been in a boom environment right now for a number of reasons. So those are kind of the 4 things I would point to, even though there's, as I mentioned, maybe 1,000 different data points that go into trying to assess the overall position of the economy. But nonetheless, I think as Lisa's chart showed as well, things have really improved quite a bit. So moving forward, again, as the economy has strengthened, if you pick one thing in the economy or one data point and look at it from a correlation standpoint, it would be the ISM manufacturing index and its relationship to interest rates. And as was pointed out previously, interest rates have certainly been moving up. This chart would basically indicate that given the numbers that are showing really boom economic type of conditions, which are surprising given where we were a year ago, there's still quite a gap between where where the economy is vectoring, so to speak, as indicated by the ISM manufacturing index, and where the 10-year treasury is right now, still hovering at only around 1.5%. Just to put that in perspective, we are still at generational lows, if not more, in terms of where interest rates are. So if they were to go up, they have somewhat more to go, frankly, in terms of moving higher. So as Lisa mentioned, interest rates are one of the things that are definitely one of the key impacts to the capital markets. Looking at that in a little more depth, and the big concern right now, if I had to pick one thing, is this concern over, will inflation stay in this range? Or first, will inflation get to where the Federal Reserve is trying to get it to, which is effectively 2.5%, if not a little higher in the near term? But the concern is, does it get out of hand because of all the immense surplus support that's been put in the economy, both from a monetary standpoint and a fiscal standpoint? And from our view, the jury's out, because we are definitely in uncharted territory in terms of the amount of monetary support that has been put into the economy. We're still buying, the Federal Reserve is still buying $120 billion of bonds every month. That's an enormous amount. The federal government is running at deficits that we haven't seen since World War II. So there's financial implications to the economy longer term, which I think it's hard to say if that's going to be, if you can be very sanguine on that, say in the next 3 to 5 years in terms of what the impact might be on inflation. So a couple things that we do look at on the left is the bond market is already factoring in the potential for higher inflation, and it does so with a mathematical construct that's known as the 10-year break-even rate, which is basically a way of using the Treasury inflation protected securities market, or the TIPS market, and comparing it to standard 10-year Treasury bonds. When you look at that relationship, the bond market is right now pricing in an inflation number of 2.5%. That's significantly higher than the printed numbers we've been seeing, which are about 1.5%. So the market has already been pricing in somewhat higher inflation. It's not at a worrisome level or not, but clearly the market is priced in a lot more. On the right is something that Lisa alluded to as well, which is the yield curve. The yield curve has been one of the best indicators of economic activity for a number of generations probably. But it's becoming increasingly steep, which means that longer-term Treasury yields are moving out higher or more rapidly than short-term rates, which makes sense because the Federal Reserve has basically pinned the front end, that being the Fed funds rate, at effectively zero. But not unlike what you see on the left, the bond market is starting to price in some fear over inflation and has to start pricing that in. So long bonds have been more impacted than short bonds, and you see that in a rising or a steepening yield curve. So the point on this is that it validates sort of the biggest concern or the biggest risk we think that the market has right now, which is this concern over inflation longer term. So let's move a little bit to the equity market. It's been a stunning rally in the market, and maybe not so surprising given the kind of financial support that has been provided to the markets. It's had to go somewhere, and our estimation right now that a lot of that has not gone in as much to goods and services, which it really hasn't been able to when you've been in a lockdown environment, but it's gone into the financial markets, and it's pushed valuations up fairly dramatically. So this chart shows basically a very simple line. The black line is earnings per share for the S&P 500. The blue line is just the level of the S&P 500, which remains at record levels. When you have a gap like this between the two, that is a manifestation of a very high multiple in the market, or basically the market is paying a fairly high level for what are still currently subdued earnings expectations. Now we think earnings will improve, as again Lisa's chart showed as well, but earnings have to come through and really validate the dramatic rise we've seen in the equity market over the last year or so. So it's kind of a show me market in terms of this right now. So it looks like so far that we've had just the preliminary earnings numbers for the first quarter, and the banks have been the first ones to report, and earnings, at least so far, and it's a very thin sample size, have come in fairly well right now, but we'll see. There's a long way to go in terms of earnings reports for the next quarter. So I'm going to turn a little bit, get a little more granular with you, and talk about more specific markets. And I just pulled this out. This is, I'm going to start building how we build portfolios from a multi-asset standpoint. And this is a universe of asset classes that we use in building portfolios. And this specific asset monitor leans a little bit more to income-oriented assets. And I do that because there's been this question out there too, is where do you find yield in this market? When you have a 10-year Treasury yielding 1.5%, it's probably the question I get the most from people is, where can I find 4%? Well, it's really difficult, let's put it that way. But so all of these asset classes you see on the left, we use in some way, shape, or form in building multiple multi-asset class portfolios. Some of them you may not be familiar with, particularly things like mortgage REITs or master limited partnerships, et cetera. These are areas that we look at and use in that they are what we call alternatives to fixed income. They're higher risk assets, but they've provided meaningful returns at certain points in time. So I know there's a lot of numbers on here, but let me point out a couple of them, and I tried to yellow the ones that were important. First, on the left, you see in the first quarter of this year, the dramatic decline you saw in values of the 30-year Treasury bond. So treasuries are supposed to be a risk-free security, but they are not if you are needing to sell them between now and maturity date. So you've had a 15% loss in terms of owning long treasuries. However, leveraged loans, which are a floating rate instrument, which do not have any real implications from rising interest rates, have been relatively flat. So I just wanted to point that out first, that there's a lot of variability in terms of where things are in the interest rate environment or in the bond market, different sectors of the bond market, that is. Moving into the next column to the right, you see it even more dramatically from where we were at the bottom in 3/31 of last year. That's right when we were hitting the pandemic. Even since then, the 30-year Treasury has lost 20%. Again, that's a pretty substantial loss for investors. Or compare that to up above, you see general equities were up about 56%, and even a specific area of the market known as mortgage REITs, which these are portfolios of mortgage securities that are leveraged, were up over 100% in that period of time. So progressing even a little further in terms of all these asset classes, on the right, the 5-year performance number is something that we find that I wanted to point out as well, because it's a sector of the market that few people really follow, but it's been surprising in terms of its performance, and that's convertibles. Who would have thought that convertible bonds over the last 5 years provided actually a better return than the general equity market? It's been a unique market. So where can you get yield? And that's on the right. That's the question that gets posed to us a lot, and I'll try to highlight a few things. First, if you look at, because rates have been pushed down so low, right in the middle there, you see U.S. high yield bonds under about 4%. This is the highest risk element of the bond market, and it only getting about a 4% return is somewhat uncompelling, at least right now in our view, given that long-term default rates in the high yield, or aka junk bond market, are about 2%. So you really have to cut off about 2% from this in terms of what your realized return is going to be if you're in the high yield or highest risk element of the market. However, right below that, you'll see preferred stocks. This is an area we like. You're actually able to get anywhere from 4.5% to even 6% on some preferred stocks. Bank earnings have been very good. A lot of the preferred market is really driven by bank securities. And if you get a 4 to 5 to even a 6% yield on some bank preferreds, we think that's a nice place to find yield. Lastly, and then I'll move on, is well, two things. Down below, you see leverage loans. I mentioned these are loans that are more senior securities, but they are still for companies that are below investment grade. However, they are floating rate, and if you have a rising interest rate environment, you're not exposed to rising interest rates, but you are exposed to credit risk. We think you're fairly paid for being in the leveraged loan market, at least for right now. And finally, down below there, you're still stuck with a 1.6% yield on 10-year treasuries, which to us seems rather almost confiscatory. If you have an inflation target of 2% by the Federal Reserve, you're going to lose real purchasing power if you buy or own long-term treasury securities. So that's a quick summary of a lot of granular asset classes that we use. And I wanted to then move on to what we do with all this information in terms of building multi-asset portfolios. So hopefully, if in your studies by now you have come up with, or have been studying Markowitz and modern portfolio theory, aka MPT. And the whole genesis of this is you use all these asset classes and you mix them together in an optimal way to build an optimal portfolio to get a certain amount of return for a certain amount of assumed risk. And so, as I mentioned at the outset, just so you know, this stuff actually does get used if you have been studying it in either your finance classes or economics classes. So we take a lot of the data that I just talked about of those asset classes, we put in expected returns, and each one of these green dots is the long-term returns for different asset classes. There's about a dozen or more of them here. And those are all just single points in time. So you then put them into an optimizer. And again, talking about careers that they're out for people as they're starting in the investment world, this has been a booming area, is using quantitative analysis, using statistics to help build portfolios, as I'm talking about here, an asset allocation portfolio. As you mix these in together and put them into this statistical optimizer, the goal is to try to get to somewhere on that red line, which, as you hopefully have studied, is known as the efficient frontier, which is the most efficient portfolio for a given amount of risk. I won't go into the gory details of all the blue, because we also do some Monte Carlo simulations, about 10,000 iterations for all these asset classes. Again, I say that just to highlight a lot of data scientists and a lot of computer programming power has to go in to do these. So pay attention for, if you have any intentions of doing programming. Seems like everybody we hire right now can speak R. I can't speak R, or Python, but our young staff certainly does. So we then build our portfolios in this very specific, analytically rigorous way. So lastly, what's our view of the market, of the world? I'm going to go through what I call the market balance sheet, both the assets and the liabilities. And similar to Lisa, we're pretty balanced here. I think Lisa used the term that they're kind of glass half full. We might be a little bit more on the maybe glass half empty just because of valuation is so high, but let me just quickly skim through these. Vaccination efforts have been really strong in the US. The liability, though, the rest of the world has not been so, particularly in certain parts of Europe. We've seen a rapid economic recovery here, surprisingly so. However, some have referred to it as a K-shaped economy. By that, the left part of that K was a dramatic decline last year, and we've only seen recovery in certain areas of the economy, whereas other parts of the economy, particularly those in the service area, have really suffered. We need to change that. We need to get a more robust, broadly growing economy. Earnings and profit margins have been strong for a number of years. However, there's potential, as I talked about, of supply chain issues maybe starting to dent these profit margins as supply chains have to get repaired. We've seen unprecedented Federal Reserve support. I mentioned that before. The market could start taking a little different view of this if it feels like it can't keep inflation in control because of all this monetary largesse that's out there. Market breadth has been improving quite a bit away from just what was known as the FANG trade, that being just high-tech, large growth technology companies. Over the last 6 months or so, we've seen a dramatic improvement in terms of other parts of the market, namely small cap names doing better. However, even though we've had breadth, valuation is historically very high right now at 22, 23 times earnings. We've seen surging fund flows coming into the market. However, we've seen also significant signs of speculation. A few things to point out that worry us a little bit. Bitcoin, we saw Coinbase come public yesterday at extremely high valuation multiples. We've seen what are known as blank check companies, otherwise known as SPACs. And the one that you sometimes see this when you see elevated levels, you start seeing blow-ups in certain investors, and we saw one with a hedge fund called Archegos, which had an enormous amount of leverage that just blew up a couple of weeks ago. So just these warning signs of some speculation in the market. Currently, there's massive fiscal plans going on, highlighted by the infrastructure plan that President Biden is talking about. However, we'll see what happens. There are potential tax hikes that go along with this. Markets typically do not like significant rises in corporate tax rates, and they've been talking about those. So, in summary, we're sort of we think it's fairly balanced. Valuations are high. We're staying in the market, but we're sort of at a neutral position. And the outlook is this going to be a real sustainable market going forward? A few of the sectors that we like, we tend to stay a little bit more domestic right now. If we're in international, it's more in the developed countries. Emerging markets may have a little challenge if the dollar strengthens with higher interest rates. And however, we're still staying with some of the reopening themes that we've seen in the capital markets. So with that, that's hopefully a really quick summary, and I'll turn it over to Scott and Bob to take it from here.
Thanks a lot, Mark. Next up, Bob Thompson, Robert Thompson from Mairs Power. Just a quick bit from his introduction. Bob directs the fixed income investment management activities for Mairs Power, including the portfolio management, research, trading, and investment risk management. In this role, he implements fixed income strategy for the individual bond portion of client portfolios and the balanced fund. Shortly after joining Mairs Power, he was promoted to vice president. In April 2018, Bob was named co-manager of the balanced fund. Bob earned a Bachelor of Accountancy. Gosh, how did this happen? You didn't tell me this at any point in our warm-up meetings, Bob. You earned a Bachelor of Accountancy from the University of North Dakota and an MBA in finance from the University of Minnesota. He's a CFA charter holder, chartered investment counselor, and a certified public accountant. I have no idea how we got you through, but good to have you here. Thank you.
Thank you, Scott. I'm gonna see if I can share my screen here. Okay, is that coming up for everyone?
Looks good. Yep.
Okay, great. Thank you. Thank you, Scott. Yes, I am a Fighting Sioux. I am a hockey guy. So I do root for the Bison in football. Well, unless they're playing North Dakota, but anyone who brings North Dakota a championship, I'm all for. And North Dakota State has done a lot of that in football, and North Dakota has done a lot of that in hockey. So it's a great sports state. So going into my slide presentation, I'm Bob Thompson, the Director of Fixed Income, but I do run a lot of equity money as well. I manage our pension plans for institutional. So I manage about 800 million in equities and then about $1 billion in bonds altogether. Joined the firm in 2016, and we recently also just started our Mairs Power Minnesota Muni Bond ETF literally a month ago. So brand new product out there, and I have been working in the industry since 1994. In fact, I worked with Mark back in the 1990s in high yield. I think he talked about the high yield interest rate is 4% or just slightly under. Back in the good old 1990s, we didn't look at too many deals below 10%. So the world has changed quite a bit over the years. Let's see if I can get down to. Okay, on page 2. So Mairs Power, we are a boutique investment firm, about 10 billion in assets. We've been around since 1931, so this is our 90th year. Started after the Great Depression of 1929. I mean, the crash of 1929, and kind of interesting that we came out of 1929 and after the Roaring '20s and the Spanish flu of 100 years ago, and here we go again with another flu and all this talk about potentially the Roaring '20s coming in front of us. So I have a lot of the same thoughts that Lisa and Mark have about the economy, and really with inflation and interest rates being probably the biggest risk factor out there. And of course, none of us really knows the answer. But as far as Mairs Power, we are a long-term buy and hold. We look for companies with a long-term, durable, competitive advantage. And we do have a focus on the upper Midwest, but that's not the only place, obviously, that we can invest. But we do love our Minnesota companies, and we try to invest in them as we can. I think we've actually been holders of U.S. Bank for decades and decades, and one of our largest holdings. And if Thrivent was public, we'd probably be holding them as well, because both are great companies and have done wonderful over the years. Going to the next page, we are SEC registered. We're 100% employee owned, but we are small, 43 employees with a little over 10 billion in assets under management. So going on to, I want to start with just a chart on the Fed and the federal debt. And I want to look at the bottom of the chart. And really, when you look, you're starting in 2004, but this goes on before. And we can kind of see from the chart that prior to the great financial crisis of 2008, 2009, the Federal Reserve balance sheet was fairly stable at under $1 trillion. The growth of the Federal Reserve accelerated following the great financial crisis as a mechanism to lower interest rates and provide liquidity to the financial system. The Fed balance sheet has really exploded since the beginning of the COVID crisis started roughly a year ago. We know that the great financial crisis was brought about by too much real estate debt, which was really caused, in my opinion, by the government, which in their infinite wisdom thought that every person could handle payments of a home mortgage, perhaps 2 or 3 or 4 homes. This worked until it didn't. It left the banking system in shambles as they were extremely over-leveraged, and it caused the entire financial system to teeter on the brink. This is where the Federal Reserve came in and, in my opinion, sort of saved the day. They bailed out the entire financial system with asset purchases and other guarantee mechanisms. Fast forward through a decade of really relatively decent economic growth from 2010 to 2020. The key criteria of this economy were aging demographics, which tends to be a bit deflationary. Globalization reduced the cost of products, a bit deflationary. The result was low inflation and low economic growth, but both were positive. And this consistent growth provided a fairly strong stock and bond markets due to the low interest rates and also steady economic growth and a record low unemployment rate. So the key takeaway from this chart is why does it matter? I believe that many of us would not be sitting here today in relatively good economic shape without the backstop that the Federal Reserve and our reserve currency status provide. I'll go on to the next page. So what does this mean for the outlook for economic growth post-pandemic? Well, certainly we saw that in 2020, the COVID crisis, 1 year ago on March 23 was the bottom. And what happened? The Fed came in and basically did what the European Central Bank had to do a decade ago, is basically, we will do whatever we need to do. And so the Federal Reserve saved the day again. And this has helped to really strengthen the economy over the last year and kind of bridge the gap from COVID to where we are now with the vaccine. The big thing is if folks or the world loses confidence in either our Federal Reserve or reserve currency status, the economic and financial system could be in trouble. I don't believe that will happen, but that's, to me, is another big risk in line with inflation. So the stimulus package and the vaccine are expected to result in very strong economic growth in 2021 after a difficult 2020. However, the stimulus package of roughly $3 trillion is mostly one-time payments. How will the economy maintain growth in 2022? Will we have a recession in the second half of 22, right during the midterm elections? Or will the $2 trillion infrastructure bill, stimulus bill, keep the economy humming? This is another big question as we go through the next year. What will real estate and work from home look like after the pandemic? The only thing we know for sure is that it will be different than pre-pandemic. Geopolitics, they seem to be getting worse every year. China is trying to establish itself as an equal to the US, and really all of the communist countries are trying to cast doubt on the democratic free system that we enjoy today. Global debt levels. Global debt levels have continued to climb every single year, and then they explode every decade when we have a crisis. Global debt climbed by $24 trillion last year to $280 trillion. This is 350% of global GDP, which is $80 trillion. How long is this sustainable? The US accounts for a little over a quarter of global GDP. The US and China together account for 40%. Europe and Japan account for another 30%. So the US, China, Japan, and Europe account for nearly 3/4 of global GDP. But we're adding debt faster than we're growing GDP. The main point is global debt is growing much faster than global GDP throughout the world. How long can this be sustained? Cryptocurrency and specs. Mark mentioned a little bit about cryptocurrency. I'm like Mark, I don't understand the R that well, but we all know that cryptocurrency has come about for two primary reasons. One, the need and desire for digital currency, but also the question mark about reserve currency status for big countries around the world. Now, I personally believe reserve currency status is absolutely paramount and will not go away. And my key points of the previous chart, that our reserve currency status is literally the reason we are all able to enjoy this conference today and sitting here today, is because of the US dollar and other reserve currencies around the world. That will not go away. So cryptocurrencies will not take the place of reserve currencies, in my opinion. But they are an asset class. They do have a large purpose. I mean, they're at the very minimum, they're digital gold, and they will probably be a good asset if we do run into inflation. So the two main points, they are not going to displace the dollar or other reserve currencies, but they do probably have a long-term future. SPACs. Now this is an interesting one. SPACs are a quicker way to do an IPO without actually having a company. This reminds me of the late 1990s when anyone with a www address could issue an IPO. This is, in my opinion, this is a bubble that we really have to watch. Cryptocurrencies could also become a bubble. I don't think it is yet, but it certainly could be a bubble. So what is the market outlook and key takeaways? Just like Mark and Lisa, I think the number one risk factor to watch for the next 12 to 24 months or even longer is inflation. Prior to COVID, I would have placed extremely high likelihood that inflation would stay sub 2% due to the deflationary factors that I mentioned, demographics, etc. Though we have seen some globalization go away, that was deflationary. Bringing back manufacturing could be a little bit inflationary. Now, however, the Federal Reserve and modern monetary theory is printing so much more money than it has in past crises that the likelihood of higher inflation is increasing in probability. I still believe that longer run inflation will remain low, despite a very likely spike in inflation this year and perhaps in 2022. But the confidence level of that has to be lower. Interest rates, they are also likely to stay low as long as reserve currency status remains strong. Rates can rise, and they are likely to rise, but only by so much if the government is going to be able to service the ever-growing debt that I talked about in the global debt bubble. I would put the range of potential interest rates at between negative 0.5% and plus 3%, with fair value right around the current level we are today of 1.5 to 1.75. Longer term, during periods of economic weakness such as 2020, we will see rates go lower. During periods of economic strength such as this year and into 2022, we could easily see rates go higher, perhaps 2, 2.5, maybe even get up close to 3%. This leaves investors chasing fewer, more risky alternatives to achieve the returns necessary to satisfy liabilities. Low rates are obviously better for longer duration assets, such as growth stocks, etc. However, value stocks should outperform during periods when interest rates are rising. And owning companies with long-term durable competitive advantages will always pay off. Both equities and corporate bond spreads should do relatively well in the current environment, but we will definitely have to watch the inflation. That is probably the biggest factor and what impact it could have on rates. And longer term, it's the reserve currency status in the Federal Reserve that are just massive in my mind. With that, I'll turn it over to Scott.
Thank you, Bob, and thank you to all of our panelists here. Audience, once again, if you have questions, feel free to submit them. We'll try to get to them in our remaining time. There is no hard stop here, so as long as the conversation feels rich and robust and the questions are coming, we're happy to stick around past 4 o'clock, and then we'll transition into the student piece whenever we get there. So the first question to each of you, and you all really hit on that same general concern that inflation, interest rates ticking up is the risk. None of you mentioned the potential downside if that risk were realized. So let's say we get to 3.5% inflation or 4% inflation. What is your forecast for what that means for markets? We've gone through inflationary periods in the past, and it hasn't necessarily been bad for markets. In fact, many think you should stay all in equities during times of inflation because they'll inflate too. So what is the financial market guess that you all have? What is the trigger that inflation brings to financial markets that has you so worried? And then what is the downside risk? And maybe we can answer in order of presenters, Lisa first.
Great. No, thank you so much, Scott. And to your point, while we've all pointed out inflation as a potential risk to the market scenario, it's not necessarily a stock and pad answer. So really what the key is with inflation is both not just the level, as you mentioned, what if it goes to 3.5% and 4%, but it's the pace of the increase as well as the duration. And our base case scenario actually is that we are going to continue to see some inflation here through the first half of the year. But in the second half, our belief is that inflation actually should go back down to more moderate levels. And the reason why is if you just look at the comparables for last year, what you had obviously is a very tough first half in 2020 as the COVID pandemic really slowed down economic activity. But then again, even as we began to move through 2020 and we got some pickup and a little bit of reopening, the pace of economic activity actually started to pick up in the second half of last year. And so what that means for this year is that as we move into the second half of 2021, there's actually tougher comparables if you compare year over year, the relative potential for price increases. So while again, our base case is that economic activity will pick up, there's some tougher comparisons that they'll go against year over year that will moderate down the rate of inflation.
I guess I'm number 2 here. Hey, Scott.
Yep.
I guess I would say, yes, and I think we're all saying, we're concerned about what happens with inflation and hence what it does with interest rates. So obviously they go hand in hand. So if you go to, let's say you get a 3%, 3.5% 10-year treasury, I think you're going to have different implications across the markets. We've already seen last year, starting in November, this huge rotation into the sectors that had really vastly underperformed the large cap growth, aka tech space. So if rates go higher, you could see that continued emphasis of these rotating areas. Value has underperformed for 10 years, if not longer. So I think there could be the beneficiaries. And if you look back to what happened in the last time we had this big rotation when the dot-com bubble burst, value came out and did pretty well, sort of the standard, more standard type of companies. I'm not saying that's possible because there's still a lot to be said for technology is vastly different than it was during the dot-com bubble blow up previously. These are immensely important, profitable companies that just churn out cash flow. So I'm not de-emphasizing, but I think you could see, even if with higher interest rates and still how much money is out there, it could continue to go to areas that have underperformed for so long. So it's not just one, it's not a homogeneous equity market. There's a lot of different areas. Banks would do very well, energy would do very well, et cetera. So.
Anything more you want to add?
Yeah, I'll just go in and, I'm a little bit, I think inflation is going to run a little hotter, maybe and probably into 2022. And so kind of like Mark said, I wouldn't be surprised to see rates go a little bit higher than what is anticipated. I do think long term, I'm an interest rate bull long term. But this is an immense amount of money going into the system. And it'll be interesting to see, because I do think, like Lisa, that eventually we're going to be lapping numbers that are going to be tougher to, keep running up inflation numbers. So another key thing to remember is we had, after 2009, the great financial crisis, we had pretty good bouts of the same types of inflation in 10, 11, and 12. Commodities inflated, everything inflated because we were coming out of the same. And the one big difference that makes me a little more concerned today is that out of 2009, the banks were in shambles. The economy was in shambles. It took years. In this case, we know a part of the service economy is in tough shape, but the rest of the economy is not in shambles. The banks are not in shambles. They're ready to loan, and that could make that inflation run even hotter than we think. A big difference back then, Brazil, South America really ran hot. This time we are not seeing them run hot. As one of the items Mark put up was about, the rest of the world is not coming through COVID as quickly as we are. China's already ahead of us, so maybe the rest of the world will offset. But to me, the economy is in better shape than it was a decade ago. But we saw inflation run. One other key thing I guess I would say is that interest rates are much lower and duration is longer. So back a decade ago, if interest rates went up 1% and your duration on a 10-year treasury was 7, when the interest rates were higher, you lost 7 points, but you gained 4 points of income, so your return was -3. Now on a 10-year treasury, your duration is 9 and you have 1% coupon. So now you're going to lose 8% on that same asset that a decade ago lost you 3.
Thank you, Bob. I want to come right back to you and just go in reverse order with our next question. So you mentioned being a Treasury bull. Can you comment for, my entire adult life, people have said at some point yields are going to rise, and then you look at 40-year charts and it's just steadily down, down, down. How can you still be a bull? I guess you just keep doing the same thing, right? Because it's been working.
Yeah, no. For me, it's a simple math. The only way to be a AAA and retain reserve currency status is to be able to cover your interest expense. The real number is 8.5, but I call it 10 times. Then said another way, you can't spend more than 10%, roughly 10% of your revenues generated on interest expense. So if you're the U.S. government, you just solve for the interest rate that allows you to do that. Now that doesn't factor in inflation. It doesn't need to. If inflation goes out of control, though, the other critical criteria in the formula is confidence. If the confidence starts to be lost in reserve currency status, it's going to go straight up. When people would tell me, I think interest rates are going up to 4 or 5%, like Bill Gross and Jamie Dimon said, like, it's not. It can't mathematically go to 5% for any prolonged period of time. It could spike up for a short while, but if it goes to 5, it's going to 50. It's going to 500. So it's a straight mathematical. We rely on the Federal Reserve. We rely on our reserve currency status. And the average interest rate that basically allows for that interest coverage is right around 1.5 to 1.75. So that's why I call that is fair range. And so you're plus or minus 0.5 to plus 0.3. Can it go higher? Absolutely. In times of economic strength. And can it go lower? Just like it did last year in a recession. The next recession, it's probably going to go down to 0 or below 0. It should never go below 0, but we've seen around the world that it will. So am I still a long-term bull? I don't see anything changing. And so, yes, I'm a long-term interest rate bull, even though I think rates are going to climb this year and maybe even next year, unless something changes. The money printing is a factor that, brings everything into question. Because if the money printing grows enough such that inflation really grows, then it's a different deal. And is it going to impact confidence in the reserve currency, or is it going to impact the economy? Is growth going to grow above trend because of that? So yes, I'm a long-term bull.
So shifting to Mark a little bit and shifting to equities. Just yesterday, Meb Faber was out with a tweet that the last time we've seen a Cape 10 ratio at 37 was in 2007. And for the next 10 years, it was in emerging markets. For the next 10 years, return has been 0% or was 0% from 07 to 17 in emerging markets. Lo and behold, the US stock market hit 37 on valuations, the Cape 10 yesterday. It's only been there one other time in 2000. You mentioned valuations being a big worry. At what point are they so worrisome that you just say, even less than glass, what did you say, half empty, like just empty out completely because of the valuation piece, or it just doesn't make sense at these levels?
Yeah, well, I know one thing is you mentioned we've been waiting for 10 years for interest rates to go up. CAPE has been something that's been out there, as a warning sign for equities for quite a while. It's been elevated, but you're right. It's at levels now that are quite high. Now, the first response that people have is, well, interest rates are really low, and that's very true. You do need to adjust CAPE for where interest rates are right now. When you've got interest rates at 1.6%, the math is such that if you take CAPE at 37, let's say it's 36, 37, you basically turn that into what is the yield in the equity market using that metric. You just take the inverse of that, the reciprocal, I should say, and you get about 2.7%. That's still higher than a 1.6% 10-year treasuries, which doesn't make it, it's still highly valued. We did some work on this actually, and it showed that when you're at this, you have to look at equities relative to the risk-free rate. And when you do that, you say equities still come out ahead, but not by nearly the magnitude that you saw when CAPE is much lower. And that just makes intuitive sense. So, I would never say it's different this time. It is a concern when CAPE is up as high as it is, and just nominal PE multiples are. I mentioned this at the outset. Earnings have to validate where the market is right now, I think, and we're starting to see it. I'm not saying it's not going to happen, because at least the very preliminary numbers are that earnings seem pretty decent. And if I saw Jamie Dimon was out yesterday, and Jay Powell as well from the Fed, they're talking about a booming economy. If you get a GDP that's running 7-8%, you could have some pretty healthy earnings, which might validate it. So it's a concern. I think one thing you can say is longer term, you're not going to get the type of returns we've seen over the last 10 years. It's just with interest rates as low as they are. So.
Thank you. And Lisa, coming back to you, when we look at some of the recent correlations, it seems like the world is just in a really different and strange place. One that has been observable the last several months is movements in the 10-year correlating with the NASDAQ. So the 10-year was, the 10-year treasury dropped today, I guess. I don't know if you were watching, but 1.67 to like 1.58. Big move in a day. NASDAQ's up a couple hundred points, and that seems so strange when you think about it, being something that normally swings like utility markets or, other interest sensitive markets. So when did that correlation start to emerge with tech? Is it here to stay? And then there's another trend we're seeing that I assume is just the reflation trend, which is lumber prices, used car prices, commodities. 40 of the commodity prices that are tracked right now are 2 deviations higher than they were a year ago. And so there's a lot of evidence there, to your point, I think, that these comparisons are making things really weird on the inflation side right now. So if you want to take up either of those questions.
Sure. So to your question about the relationship between interest rates and the NASDAQ, it is really an interesting question. And I think it really comes back to the fact that some of these technology stocks are really, in a sense, the new safe and defensive play, which sounds a little bit odd because many of us think of the NASDAQ as the great growth opportunity, but it's actually because of some of the growthiness that I think in the last couple of years, what you've seen is that investors are really looking at some of the stocks in that index as, again, a little bit more of a defensive play. When there's great uncertainty like there has been with the pandemic, people are looking for reliable growth, and they can see that not only has there been secular trends behind, for example, some of the, technology and healthcare stocks in the NASDAQ, but the pandemic actually accelerated some of the move towards that. And so people are fleeing towards the safety of that. And then what you have conversely is when interest rates go up, because they are so popular and people are flocking to them, that's really the first area that gets hit. And then I'll just briefly touch on your question around commodities. To your point, we've seen a real run up in energy and some of the other commodities over the past 12 months. Certainly it's not surprising that it's happened for 2 reasons. So one is, as we've come off some of the lows from the economic shutdowns of COVID, and any sort of demand picked up, that really pushed forward very much so to the goods sector. obviously our ability to consume services like trips to the salon, entertainment, travel was very limited. And so what demand really went to the good side, and that's going to fuel demand for more commodities. And in addition to that, you have, as reopening continues, continued push, and yet the supply constraints, because again, not everybody can go back to work. And so you've got supply chain pressures as well. Again, our base case scenario is that some of that should moderate over time as the economy begins to reopen and we can spread out that demand across a broader array of goods and services. But again, it is something, to your earlier questions, that we want to continue to watch.
Thank you. And we have a few questions that any of you are free to pick up on from our audience here before we transition to the student piece. One, which is a elephant in the room question, of course, too, just relates to the housing market. I think Bob might have mentioned it in his talk, like big unknown, not sure what it's going to look like after the pandemic. Here in Fargo, I was told that housing prices are fetching 99% of their asking price, and they're turning over, in our neighborhood without even going on the market. Some of the Zillow things you see are asking price, and then it's adjusted up. Year over year, nationally, housing prices are up about 11%. But at the same time that all of this buying activity is happening, we see stories from cities of rental prices dropping like crazy. People want out of San Fran, they want New York. Where do you all see housing in a year or two? Is it going to continue to be this great readjustment that it seems to be right now?
I think we're going to be oh, go ahead, Bob. I was just going to say, I think we're going to be supply constrained for a while. The pandemic really shut things down. And when you get those type of supply constraints, trying to get lumber in, and if you remember too, some of this was precipitated. We had this tariff problem prior to the pandemic that was causing some challenges. So I think you just got to have this continued supply issue for a number of reasons, and the demographics are now switching. And now you can, with working from home, there's this demand. You don't have to be in cities. You can go somewhere else. So you've seen this tremendous demand in places, particularly warm weather places. So I think it'll be continue. I think housing is will remain robust.
Warm weather places like Fargo. No, I agree. I agree with everything Mark said, and I just think it is going to be a challenge because you've got the pandemic thing moving. Folks are moving around because of the pandemic, and then you've got, the cost to build a house. Your house in Fargo, Scott, probably would cost right now today 150 to 200% of what you could sell it for. So it's going to be very challenging for builders to really accelerate the pace that they're building because you can't get the price. And we all know from 2006 to 2007, prices and rates can only go so far before there is no buyers. And so, it will, it'll keep on going in places that, I just think you're going to get a lot more markets. A lot of these trends are going to stay. In San Francisco, you're going to continue to have people moving out where they can. Now they make more money, they can afford. If you're moving from a San Francisco market to Salt Lake City, you can afford a heck of an increase in Salt Lake City because it's a drop in the bucket compared to San Fran. But I think it's going to be it is going to be interesting. And we've even recently seen just the rate rise of 1%. This year has already slowed down refis and things like that. So we're already seeing some impact, which has been real interesting. The other thing about interest rates is and another reason why I'm a long-term bull on interest rates is the rest of the world is at zero. Anyone who thinks we're going way above that doesn't understand that the rest of the world is zero. And they're going, unless they're going up, and they've been down there for 20 years. So if anything, I would say in 10 years, we're going to be like them, unfortunately, and we're going to be down between 0 and 1. We should always be above them because we have a better economy, we have better growth. But the rest of the world, Japan was in there buying the most bonds they bought in a long time, because they can hedge it back, and they're earning 1.2% more than buying in their own bonds. So that's also another cap on interest rates in the long run, unless the rest of the world all climbs as well. And so there's just going to be a lot of very different, pieces of the market in every aspect.
Lisa, anything you want to add? Or
No, I'm similar to what Mark and Bob said. I think in the near term, we actually think the housing sector is pretty interesting. And in fact, one of the areas within fixed income that we think is interesting to have an emphasis on is non-agency mortgage-backed securities. And so just to diagnose that a little bit, these are securities backed by mortgages that are not necessarily guaranteed by the federal agency, so hence non-agency. And again, to your point, because of the big demand for housing that was really spurred by what's going on with the pandemic, people are in that market, continuing to demand and foster interest in these particular securities. I think to the points, though, that Bob was just making in the longer term on housing, it is a little bit more of a question. If you look at a lot of the housing indicators, they are still strong, but they're starting to decelerate a little bit. And I think that, the steady state on housing, how much housing will people continue to consume, let's say 3 years from now, is a little bit of a question.
We have another question about corporate taxes. And Lisa, I want to bring this to you actually in your last slide about flinching. So there's the fear of policymakers flinching. The Fed has said we're not touching rates until 2023. They have a credibility issue there on will they renege on that as inflation picks up. Larry Summers has said this is the most risky economic policy he's seen in 30 years, and he's been very critical of the Fed at the moment. So there's the flinching issue, but then there's another market risk, which would be around how are we going, the concern of how are we going to all pay for this? And Biden has to walk a line of, do I raise the corporate tax? Do I raise wealth taxes, capital gains taxes, dividend taxes, things that could impact financial markets? And is any of this coming into your outlooks in terms of a headwind risk going forward? Or is that just something that probably won't get touched because of politics and because we're going to wait a while for the recovery first?
No, thanks for the question, Scott. And you're exactly right. While we tried to highlight one of the biggest things on our mind, which was inflation and interest rates and the possibility of a flinch, there certainly are other concerns as well. And certainly in the policy area, the whole issue of taxes is another big issue. And so if you look what's going on, with the current policy discussions on the fiscal side, you have the positives of potentially more stimulus to, at least in the nearer term, continue to bolster spending. But again, the talk of taxes offsetting that is a potential drag. And, when you look at how that affects stock market valuations, essentially, if, companies or individuals can take home less, right, there's less to value. And so that is a big issue that we're continuing to monitor is, as these discussions come through potential infrastructure stimulus and how it's going to be paid for, how those two actually shape up in the end.
Thank you. One more question related to your presentations, and then we'll ask you a little bit about careers, and we can always come back to this content that has been asked already. But a couple of questions on here about valuations. What is your preferred valuation approach in a market that seems pretty fairly valued to overvalued? Are there any particular techniques that you prefer? And this can be for any of you.
I think one thing is,
I'm happy to. Oh, I'm sorry, I cut you off.
No.
Go first.
No, I thought I'd jump in there, and then I think one thing is the markets are extremely broad in terms of different asset classes, and particularly in the equity market. There's small cap, there's all different kinds of industries. I think it depends on what type of a company you're valuing. Is it a growth company? Is it there's not just one metric, I think. And we fall a little bit into the trap of, well, the S&P 500 is at X multiple. Well, that's made up of a lot of different multiples across a lot of different sectors. So at the end of the day, it should be, what is the cash flow free cash flow generation of a company? Look at it the way we have a significant private equity portfolio. At the end of the day, from a long-term standpoint, you should do it the way an owner would look at it. And that's, what is the value? How much can you generate in terms of free cash flow generation as if it were a private entity? So that's how I might first respond. So.
And I'm just happy to build on what Mark said and say, from valuation from our perspective really should depend on a mosaic approach. And I think you ask a really wise question, Scott, which is, is there one that's better than the other? But, there's a number of different measures that can tell you different angles on, how cheap or rich a market is. The other thing I would say is that from our vantage point, valuation is an important factor, and we do want to be aware of, again, the range of indicators in that area, but we do not view valuation as a catalyst. So what do I mean by that? What I mean by that is markets can actually stay expensive or cheap for quite a long time. So it's important, again, to be aware of overall levels, but it's typically fundamentals and sentiment that will drive momentum in the nearer term. And at some point, investors circle back and they recognize valuation. But as far as, a timing mechanism, it's a little harder to use valuation at any one point in time.
Yeah, Lisa makes a great point. A lot of mistakes have been made by using valuation because it is a terrible short-term timing mechanism. It's awful.
Thank you. Shifting gears to just the career piece here for a few minutes. I'm curious how each of you got into this industry. I'm not a financial expert by any means, but I'm an economist. Became interested in financial markets nonetheless at like age 12. I had to read the Wall Street Journal to my grandfather, and he was driving and I got to read until I was car sick. So I learned about Westinghouse Electric and a bunch of other stocks that were the hot stocks of the 1980s. Then econ came thanks to just a really great professor at the undergrad level, and the rest is history. How did you all get into your businesses? And, can you talk a little bit about just the challenges you faced early on in just getting through school and getting your foot in the door at respectable places? Maybe Bob, if you want to start.
Thanks, Scott. I started out, I went to, University of North Dakota, the hotbed for high finance. And so I started out as an accountant, literally counting beans for Cargill Incorporated at a soybean processing facility. I did that for 4 years till my sanity. Counting beans for 4 years was enough. And then I moved back to the Twin Cities and I went to University of Minnesota for grad school with the goal of getting into investment management. And I had a stronger desire to be in Minneapolis than I did a desire to work in equities. Of course, when you start grad school, nobody even knows what fixed income is. But you quickly realize that, at least back then, it probably is still the same, but there's actually more opportunities in fixed income than there are in equities in a lot of ways, because all the insurance companies and whatnot that the global debt, that $280 trillion goes somewhere, right? And so there's a lot of people managing that money. So through grad school, I got lucky enough to start with Lutheran Brotherhood, Thrivent Financial. And I started out in municipal bonds and went into corporate investment grade bonds and then into high yield, and then moved over to St. Paul and worked for Securian Financial for about 13 years before Mairs Power. And there I got the chance to actually do equities and fixed income, which has always been my dream. So it's just been fantastic to be at Mairs Power, but all four, including Cargill. And I'd say the number one, kind of like Mark said, is you've got to have good technology skills. We came up in a time, we were pre-technology. I didn't get a Bloomberg on my desk until the late 1990s. I could not do my job without it. I literally could not do the job without it. You've got to have, I think the number one skill, if you want to be an investment man or whatever whatever it is you want to be, it's got to be, you have to have a genuine interest. It's not, I started out in pre-med. I did not have an interest in being a doctor, but I thought, oh, they make a lot of money. I quickly figured out that my stomach was not well suited, and you've got to find what you love to do. And, going back to when I was talking about North Dakota, it's like a sport in a way. You wake up, you want to go play. And that's what investment management and economics is. So you have to have true curiosity, but then you've got to bookmark it with, technology skills, analysis skills, skills to be a big, think big, the big picture skills, and all those. And there's various different roles. You can be on the management level, you can be an analyst for life, you can be an analyst and a portfolio manager. Or you can be on the sales side. It's kind of like you also need to know yourself, what you have an interest in. But then, it is challenging to get that first job. And then where do you go from there? And that is tricky. And I'm a little far removed from that. So I don't have that much to really offer other than just be enthusiastic, hardworking, and, genuinely interested. With that, I'll move it to Mark.
Well, just quickly, I guess. Oops, I'm getting a little feedback there. Similar to you, Scott, I became fascinated when I was actually a kid. My dad introduced me to the stock pages of the Wall Street Journal. And I remember at the time looking at dividend yields, and it's like, why wouldn't you just always buy the one that has the highest dividend yield? That seemed really simple, but it's not that simple. So that goes way back. I guess my sister was an analyst, a research analyst for a firm that is now part of Wells Fargo. So she kind of knew about it a little bit, but I think what really got me interested, I did an internship during my 2 years of business school down at the University of Minnesota, where I got an opportunity to do what was called competitive analysis for Honeywell. And that was looking at competitors. And there I really learned an individual in particular took me aside. Brady Stringer was his name. And how to analyze companies and how to analyze a company from a competitive standpoint. I think he introduced me to some of the famous books that are on that. So that's what got me interested. And then I was very lucky. There was a posting for a securities analyst job at the time was Lutheran Brotherhood. Now that goes back to 1983. So I've been around a while, but so that was my history. And I guess the one thing is there's always something going on. There's always something new and different. It's not a static industry at all. I mentioned before, the types of people that are coming into it now, it's not just people that are financial or accounting types, it's data scientists. We're using a lot of different things now. Artificial intelligence is being used. Statistics is heavy in our world right now. So there's always something that's new. It's fascinating. So, and I'll turn it to Lisa on that.
Thanks. Well, and I was one of those people where the job found me instead of me finding the job. So like you, Scott, I graduated in economics, which I love, but I was open-ended as far as where I could go. I interviewed for a number of different types of positioning, whether it was marketing or finance. And I just ended up with a great offer from a company called Russell Investments. And it sounded really interesting. And it was in investment research. And I jumped in and it worked out. And I guess what I would encourage all of the students out there is obviously do all your work to plan and to work hard and to get yourself out there and interview. But, don't be afraid to if it's not your perfect path, because, things can happen and careers can evolve and there's lots of opportunities out there. So, I just encourage you, there's a world full of opportunity out there waiting for you. And I'm excited to, see how you guys all continue to progress.
Our students, I think, get a little bit of noisy information on the prospects of the field more generally. You all seem really bullish and upbeat on it being a great career, and also there being a lot of opportunities still. But Mark mentioned machine learning and artificial intelligence, and there's this fear that I think is out there that the quantitative machinery is just going to take over the industry, and there's not going to be a lot left for just old school analysis. Can you comment on that piece? I think Bob also mentioned technology and just being really up to date with technology, but is there still an industry there for people if some of these projections are, the gloomy ones are right? Anyone can...
I'll just take a stab at that, because we have two different, we're a large, we run about 160 billion. We have some is done quantitatively indexed and some is, fundamental active management. And even though the quant managers, it's very black box, but when they start running into problems, you got to have some judgment on why their models are not performing well. And those are particularly difficult. The quant models, we call them black box, where it's all, let's say there'd be robots. At some point in time, you do have to have some judgment on things, and that's where the human element I think comes in. So it's not just the robots are going to take over our industry. There's still as much art. There's a lot of science, but there's still some art, and the science hasn't taken over the art of this. And I think, Lisa, you used the term of mosaic. I think that's a good CFA term as well. It still is a mosaic. It might be quant-based, it might be AI-based, it might be just pure fundamental research where you dig in and you find some nugget of information from the supply chain from just a call to somebody. So I think it's still, it's not black or white. Let's put it that way.
Yeah, and I would just echo what Mark said. I think across industries, right, the increasing ability to harvest big data and use machine learning is important in our industry as well. But at the end of the day, somebody has to interpret that data, and somebody has to program that data, and someone has to train that data and give it direction. So judgment is still really an important part of it. And while there's challenges because of the pace of evolution, it's happening across industry. So I think it's just something we all have to continue to adjust to. The other thing, maybe Scott, I'll mention briefly, and I should stop so Bob has a chance to say something too, is, the other trend that you guys have probably discussed in your classes is just the whole profit margin issue. And we are an industry that is actually held on to our profit margins maybe longer than some of the other industries like technology or retail. And, yet that's still coming to us with the globally competitive world. People aren't just going to blindly pay a certain level of fees. So that is another headwind that we're facing. But again, it's a great industry. And, I know for me personally, and I'm sure all of the rest of the panel feels this way as well. What gives me the greatest satisfaction is, finances and wealth is really what enables us to do the things we want to do, to be able to care for our family and friends, and to be able to contribute to the charities that we want to. And so being able to be part of that, group that really is helping clients to achieve their financial security, that's what makes the difference for me every day.
Thank you. Bob, anything you want to add? You're muted.
No, I think their answers were great.
Okay. One other question just about your daily grind in the workplace, and it's just a work-life balance piece. The reputation of work in your industry is really long hours. Our students went with me to Minneapolis a few years ago, members of our Bison Fund, and 80, 90-hour weeks, very common, especially when you're starting out. But then there's also just this issue that you all have been there, done that with some major market downturns and not panicking or, just working your way through those. And how do you both balance work and life, and then two, know when you really need to lean in because it's an important market event versus just kind of tune it out and say, this is noise? What are your hacks for students who might be in the industry in the future on both of those fronts?
Well, I'm happy to jump in with my personal experience. And you're right, Scott, the finance industry is known for pretty long hours. And I will confess that can be true at times, especially when you're in a market-related profession like ours. I mean, none of us here around the table can just, if something happens with the markets, we have to assess that impact for our client portfolios. We would not be being good stewards if we didn't do that. But that being said, this industry is like any other, right? And companies within the industry have very different cultures. So there are segments of the industry where, again, you can have a relatively more or less work-life balance. So, being attuned to the organization and their work style and what their approach is one key. And, if it's an encouraging story at all, This is an area where you can have more flexibility than you would think. So just as a brief background, I went into it, all gung ho, and I worked really hard my first few years and got some promotions. And then lo and behold, I had a kid, right? And all of a sudden I realized, gosh, maybe I don't want to be working X hours, a week and traveling and things like that. And my employer at that time was really great. And they offered me a part-time position of anything above 10 hours a week. And you heard it right, 10 hours. So I was able to, I didn't go and beg them for that position, but again, I think if you're with the right organization and, they see value in what you're doing, there is flexibility in this industry, just like anything else. And I worked part-time for about 10 years while my kids were growing up. So there is the opportunity.
I can jump in. I would agree. And I think, like all things, it seems like there is more focus on work-life balance. So it doesn't matter what career you're in. I feel like there's, it doesn't always happen. We hear the stories of, Wall Street banks, right? I mean, you're hearing the stories of people, peel over and die. I can say on the buy side, which is, all three of us, that you don't generally have where you're working 100 hours a week. You might, when you're young, work 60, 70 hours a week, but most people have a pretty good life balance after they've got a few years of establishing themselves. The work-life balance is really quite good, and it only seems to get better every 10 years or so or whatever. For whatever reason, it actually seems to get better. The pandemic, I think, is making the work-life balance even better generally. We'll see what happens in a couple of years, but it seems like it has been positive because people have figured out what is actually productive and what is not. And so I really think it's there. There are a few jobs, just as there are, you're in residency, you're not going to have work-life balance. It just is a fact. If you're in a few certain jobs in New York City, or if you're a brand new employee at a hedge fund, you're not going to have work-life balance. But there are positive offsets to that as well.
Yeah, I might add just on that. You're right. I think we should distinguish between, Bob mentioned the buy side and the sell side. The sell side being the grind of investment banking, where you've got that's a whole different animal, frankly, and can be a real grind. I think for a lot of stuff that we do, it's just sometimes it's not work, and that it's interesting stuff in terms of you have to be interested in economics and how markets move and how capital gets allocated. You have to be interested in that, and it's one of the few industries I think that when you're really in it, it benefits you personally as well. Frankly, you get that benefit. In fact, when you're done with this, you can continue to do it on your own, managing your own portfolios, hopefully well or not. So that is a benefit too. So but it's not like investment banking, that's for sure.
Thank you. One follow-up question for Lisa, and then I think we'll ask you one more from the audience here, and then let you all go. You start to feel zoomed out after anything more than about an hour and a half, and you've been a wonderful group of guests. Lisa, we've been really intentional here at NDSU trying to encourage the field of finance to women too, and it's tough. It's an industry that's male dominated, and you can really be intentional about the opportunities, but it's still is something that it's an uphill sell, I guess, if you're thinking about it. Can you comment at all on how it's been for you as a woman in the industry, and what you would say to our women audience members who are students today?
So I would encourage, if you are interested in this career, not to be offset by the fact that it is still a male-dominated industry. I have loved my career. Hopefully you've picked that up, and it's given me a lot of interesting opportunities to talk to super smart and super nice people, just like the people here on this panel. And so it's been a great career. Again, too, if you find the right organization and kind of the right niche within it, you don't have to be working 70-hour weeks. and you can still have, some good work-life balance. So I would really encourage you to, help continue to break the barriers. I think all of us would love to see more women and diverse colleagues working alongside us. So, certainly continue to interact with CFA and take advantage of all your professors and, let us know how we can all collectively help you.
Thank you. And so one more question. We're going to end with an economist that I've enjoyed and admired throughout my career. Someone's asking a Milton Friedman question here. And it's going to force you all to remember a little economics, but it says inflation is always and everywhere a monetary phenomenon. That's according to Milton Friedman. In the past years, we did not see much inflation, even with monetary policy quite loose. One of the reasons may be that new printed money flew to the capital market. With new easy money continuing and growing, do you think it will benefit the greater economy in the long run? Or is this all financial market and financial capital inflation? I don't know who to point this one to. Anyone can take a stab at it, but we'll end on a Milton Friedman point. Bob, I guess you were talking about the Fed and the Fed coming.
Yeah, I can give it a crack. Maybe Mark wants to give it a crack too. I think with this, the monetary phenomenon, the way I look at inflation is we all know what the trend growth rate of the economy is, right? It's if you ask everyone on this panel, I bet almost everybody would say 1 to 2%. If we print enough money such that economic growth, GDP, grows faster than trend for a prolonged period of time, meaning 1, 2, 3, 4, 5 years, then yes, the inflation, the money printed will become embased in inflation. What has happened in the past is, in my opinion, we printed enough money to offset what GDP would have been lost by the bubbles bursting that we've gone through. If we get to a point where we're printing more money such that trend growth exceeds, such that growth exceeds trend growth, then yes, we will get inflation. That's my answer.
I might jump on that too. I don't know what the date was when Milton Friedman said that, but that's his famous statement. You got to think, you have to keep in mind the economy is vastly different in our banking system, and our financial system is vastly different. When he wrote that, we were really a manufacturing and agricultural based economy that really went through very common cyclical movements. We are now an information based and service based economy. We are not based on commodities and et cetera. So he said that in a different time. I think the other thing is the other thing that's not said is the assumption was that you had to have constant velocity of money, not to get all economic geeky, but that's been the big mystery for macroeconomists or monetary economists is velocity has just been non-existent. And the last thing I'd say on the financial system, he said that in a time when you had a highly regulated fractional banking system. It's really different now. You've got fintech coming on. You've got the shadow banking system where you can get credit. So I think you certainly should know your history and certainly should know Milton Friedman and his famous book, Free to Choose, et cetera. He's a giant, but also keep in mind, it's really different. Let's see who are the new economists that are going to figure out, some truisms that we're living with today in this information service-based economy.
Thank you. I think we'll leave it there and let you all get out of here about 15 minutes early. It's been just a wonderful time spent together this afternoon, and you were spared a few snowflakes today down here in Fargo, North Dakota, and I guess some more coming tonight. Apparently, it's April. It's all going to go away really soon, which is fabulous. Thank you all for joining us today. Thank you again to the CFA Society of Minnesota for their support in pulling this great panel together, continuing to partner and collaborate with the College of Business at North Dakota State. Thank you to Callie for making this all really smooth technologically for us and doing a lot of things behind the scenes to make sure the event went off without a hitch. And thank you again, Lisa, Mark, and Bob. Wonderful to spend time with you. Good night.